Are you getting money from the government? This is the IssuesWatch podcast. Hello, and welcome to the IssuesWatch podcast. I'm Matt Charne, your host for this week's accounting and auditing episode. I'm an audit director at Clifton Larson Allen. And joining me today is Marissa Flood, Assurance Senior at CLA. Welcome back, Marissa.
Thanks for having me. It's always a pleasure.
Always great to have you. And our first-time guest, Tyler Callahan, a principal at CLA. Thanks for being here, Tyler.
Thank you very much for having me.
Great to have you. This episode qualifies for Nano CPE credit. If you're interested in earning CPE credit for this episode, hit the pause button now and head over to njcpa.org/nano to find out how. A quick disclaimer, the views and statements expressed herein are our own and not necessarily those of the NJCPA or of CLA. Okay, so now that we're ready to get into it, our topic for today is an exposure draft that came out on government grants, which I believe is going to be topic 832 for any of those who want to look it up within the FASB guidance. And the article that we found nicely summarized a few key points about this, and I just want to summarize it by saying that the standard is going to be proposed for recognition, measurement, and presentation around these grants. So it's going to be a pretty comprehensive overview of how the accounting for this stuff is going to work. And the reason for that, which I only recently discovered, is that apparently there was no previous guidance. I was hoping to talk about what exactly we were supposed to do beforehand and what we're supposed to do now, but that guidance doesn't exist. So I'm glad that Tyler is here because Tyler works with a lot of nonprofit companies at CLA for us, and he's got some experience with these government grants that can kind of help us understand these new terms that are coming out, because Marissa and I, as you all may know at this point, we don't do any kind of government grant work. So this is kind of uncharted territory for us.
Yeah. So coming into the commercial side, this is going to be big for the commercial people. So if you haven't had experience, definitely listen up. And
I know there were a lot of things here that really surprised me. Chief of which being that when you get a grant these days now, it sounds like it's going to be categorized either as an asset grant or an income grant. Now, for people like us who only work in commercial jobs, I equate a grant to a loan, which doesn't necessarily seem like the right way to do it because a loan has to be paid back, but a grant not necessarily. And when you get a loan, it's kind of your money and you can just use it for whatever you need to. But now that we have to categorize these grants into assets or income, there's differences in how that stuff is going to get treated, right? Is that similar to how nonprofits are doing it or how they plan to do it? What have you normally seen?
So with government grants with nonprofits, what I've seen historically with my clients and those that I serve, I've seen a lot of strings attached when it comes to government grants as opposed to loans where you have a little more flexibility with how money is being spent. Government grants seem to come with a lot of strings attached, a lot of requirements, a lot of due diligence, making sure things are on the up and up.
Right.
So reading the exposure draft, there was a lot of focus on operating expenses, but I think a large focus has to be on whether the parameters of your agreement with the government grants, are you spending it appropriately?
Right. And
making sure you're tracking things. There's a lot of reporting that's done with government grants.
Yeah.
That might be a little bit different on the commercial side or what companies may not be accustomed to.
Right. Yeah, when we talk about loans on the commercial side, the only kind of restrictions that there might be are usually covenants. And those can be financial covenants, they can be non-financial covenants. I'm sure they exist somewhere, but I don't know if you've seen one. I've never seen one where a non-financial covenant says you have to use the loan for this specific activity and nothing else. And that would be kind of how I would think that a nonprofit or even, dare I say, a yellow book or a single audit would kind of go about testing these kinds of grants and saying, well, this grant was only for a building or this grant was only for paying your staff, something like that. So you have to track the actual dollars and where they're going. We don't really have that requirement. And sure, we have to test the covenant and make sure that your ratios are good and all that stuff. But I wouldn't equate the two.
Yeah, so this is going to be a lot different than what we're used to at all. So
Definitely.
I'm interested to see, how the nonprofit space and everything has kind of. We're probably going to lean on you guys for this.
Yes.
So I would really like
to
get more info on it.
Yeah, you guys are going to be the experts. And now that you say it's going to be very different, even within this new exposure draft, there are some differences in how this stuff can be treated. And that's kind of summarized here by the deferred income approach or the cost accumulation approach. Now, I'll just read the definitions quickly so everybody knows. but the deferred income approach is recognizing the grant as deferred income and amortizing it over the asset's useful life. And the cost accumulation approach is reducing an asset's carrying amount by the grant amount. Now, I didn't see a whole lot of criteria in here about how to define when you're supposed to use one approach versus the other. So it sounds like organizations, commercial businesses, whoever may be getting these grants, seem to have the option to just pick one or the other. But to me, they seemed really different in that if you pick deferred income, now you have a liability, and you're recording your grant as a liability and using it accordingly. If you picked the custom accumulation approach, well, now you have an asset, and you're going to reduce some kind of asset that was already in the books. Maybe that makes sense to someone like you who's got more experience with asset grants and income grants, but to me, that seems like a lot of freedom.
Yes. Looking at the exposure draft, it's kind of eye-opening, the different approaches that you can have and the options that you have. For most of the clients that I work with, they have more of the deferred income approach. So if they receive cash in advance of spending down grants in accordance with the grant, appropriate expenses, allowable activities, any cash that's received in advance of those expenses are recorded as deferred income, or grant advance, if you will, on the nonprofit side. But yeah, this cost accumulation approach, this was definitely eye-opening for me. I said that seems to be a very creative way and to record things and approach things.
Right. Creative accounting is a good way to put that. Yeah, and I immediately jumped to situations where if you had even a commercial business or a nonprofit, this may not be so much an issue for nonprofits, but a commercial business who may want to sell, maybe looking for investors, things like that, and they get this great government grant in, maybe the rest of the business wasn't doing so hot, and they have the flexibility to say, okay, well, I can either make it an asset or a liability. Which one makes my books look better? We're talking about creative accounting. These two approaches, seem to give them a lot of freedom. But I was really surprised by that, and just for asset grants and things like that. Now, on the income grant side, you also have options. Not only do you have to determine if it's an asset or an income grant, which could get muddy as you've let us know with all the strings that could be attached, but also when it's an income grant, it could either be a separate line item that just says grant income, or a reduction of some other kind of related expense. Now, it's another way to kind of gross your stuff up and down, and maybe that expense goes to COGS. Again, I'm thinking from a commercial standpoint, that's going to look really great for your gross profit. And I'm just very interested to see how the best practice kind of forms around this stuff, because there seems to be a lot of freedom. I'm curious what you guys think about that.
I do think that the disclosures are going to matter a lot
Mm-hmm.
here.
Yeah.
I think that that's going to be the focus, like in terms of our quality control and things like that. I think that we see that grant and we have to see how it's disclosed. We have to see the way they're treating it. I think we have to say what accounting policy we applied to it. So that right there, I mean, hopefully it alleviates a little bit. Like, you can't, if you're going to disclose it, you're not going to do something, or hopefully you're not going to do something that makes it very obvious. So but I do think the disclosure is going to be really important. Absolutely. And I know on the nonprofit side you have heavy disclosures surrounding this.
Yes. This was the disclosures for the commercial clients or companies. Just having that consistency too on how you're applying certain accounting treatment to your government grants that you receive. Are you doing things one way, and the readers and users of the financial statements could see a lot of different approaches. So, like I said, I'm not going to say audit procedures or anything like that, but just being cognizant of that and being consistent and logical and methodical with your approach.
Right, absolutely. So I'm glad you guys brought up disclosures, because one of the last key points of this is that the disclosure requirements are going to be updated so that it makes sense for whatever grant that you've picked. Your financial statement users know what exactly decision you've made here. So just to read off the requirements quickly, the entities are now required to disclose the nature and terms of the grant, the accounting policy applied, so whether you select that deferred income or that cost accumulation approach, you're going to be required to disclose the financial statement line items that are affected, which in my opinion is great, because if you choose to reduce some kind of expense, now everyone will know what has been reduced by this grant and why. And for tangible non-monetary assets, the fair value at the time of recognition. I had circled that one because that sounds like a lot of audit work for people like us to try and figure out. Granted that your nonprofit or your commercial business doesn't have the ability to do so, because the fair value of the non-monetary asset could be almost anything, right? Depending on what your organization is. Have you seen any kind of big examples about that, and how exactly organizations are using these grants to determine what they need and what exactly it should be valued at?
Most of the clients that I work with, or my experience has been any large purchase of an asset. Like
Right.
there is no cost accumulation approach. You're putting the asset on the books based off of their fair value.
Okay.
Overall, so that was a little deviation in practice that I've seen.
Right.
Overall, so I saw that, I was like, wow, that's interesting. I'll say it that way. So
Definitely.
the fair value really hasn't come up too much in terms of like purchasing a large asset.
Okay.
Overall, so.
Gotcha. Yeah, so that sounds like it could be a big change then.
Mm-hmm.
Anyway, one of the things that we were talking about when we were planning this episode was stressing that, this sounds great and there's a lot of flexibility in getting a grant. And a grant is, it sounds like free money on paper, but depending on the thresholds of your organization or how much money you're getting, you might trigger some kind of audit work, right?
Mm-hmm.
Do you want to talk about that a little bit, just so people know what's out there in case they're thinking this sounds great and I can move my books around as much as I need?
Yes, I would say to reach, if you're interested in getting government grants, or if that's something that is on the horizon for your company,
Right.
reaching out to the grantor saying, hey, what are your requirements going to be if we get X amount of dollars, whatever that may be, whatever state or locality you may be in may have different requirements. So being ahead of the game, rather than in the 11th hour looking at that fine print and saying, oh, by the way, you got this much money from us, we require an audit or some sort of other attest function.
Right.
So there's so many different options out there, especially during the pandemic. There was a lot of different options that commercial companies had to receive audits if they qualified for it. So rather than bore everyone with the different criteria, I'd say just contact your grantors, read your contracts, read your agreements, and see what really is required.
Right. Absolutely. I think that's a great note to kind of close out on here.
Yeah.
Okay, so in closing, I encourage you to visit the Society's Accounting and Auditing Knowledge Hub for events, articles, and resources. Go to njcpa.org/hub/accounting. And be sure to join the Society's Accounting and Auditing Standards Interest Group. Sign up for free at njcpa.org/groups. Thank you for watching or listening.